As I've always said, is crypto markets are volatile by nature. It's a 70% volatility asset class. It has deep drawdowns and it has tremendous upside. In fact, it's the best performing asset class in all recorded history.
Hey everyone, and welcome back to Finance Wolf. In this video, Raoul Pal talks about Bitcoin and other cryptocurrencies like others interested in crypto. Raoul Pal, a famous macro analyst and former executive at Goldman Sachs, is very optimistic about the prices of crypto assets in 2024 and 2025. He thinks that the total market capitalization of the crypto market will reach an unheard of $11 trillion, which is 4 times the current range of $26.05 to $2.7 trillion. As a result, individual crypto prices are expected to skyrocket to new all-time highs. Pal wants Bitcoin to reach at least $200,000 before the cycle ends in 2025. The big rise in Bitcoin's value is expected to have an impact on other cryptocurrencies, which is why Pal is especially optimistic about leading cryptocurrencies like Ethereum and Solana. The former Goldman Sachs boss thinks that Ethereum will do better than expected. At the moment, the ticket costs $8,000 and the Solana costs $1,000. Pal is generally positive about all crypto assets and technological stocks, seeing them as the only winners in this exponential era. In Pal's opinion, cryptocurrency is a unique investment opportunity that has helped small investors a lot. It not only helps them avoid losing money when fiat currency values drop, but it also gives them a chance to level the playing field that no other asset class does. Now we'll show you parts of Pal's most recent video stream in which he talks about his predictions and hopes for the cryptocurrency industry in 2024 and beyond. There was a lot more that Pal talked about, so please watch the whole thing and like and share this video. Also, please subscribe to our channel, Finance Wolf. Thanks.
But with that best performance comes volatility. It's something I warn about in this don't fuck this up thesis, which is don't take leverage. Don't try and trade around or FOMO into stuff. Just be careful what you do and stick to the basics. Stick to the bigger tokens. If you're going to degen into stuff, do it in the smaller stuff because that stuff's much more volatile. Your probability of getting it wrong is very high, although you can get 100x in the space as well. I understand that's attractive to many people, but I'm trying to keep everybody on the straight and narrow. And when you see these drawdowns, it always feels terrible. And I've been doing this since 2013, and they always never feel great. But the reality is, it's normal. So it's normal in the fact that in the last 12 months, you've probably forgotten this, but this is our 5th or 6th 20% pullback in Bitcoin. So you've dealt with this many times before. You just kind of forget it, which is weird. And I think Coinbase put out a super interesting tweet, which was there have been 5 Bitcoin bull markets. In an average bull market, you'll have to survive the following to ride it to the top. 6, 5 to 10% drawdowns, 3, 10 to 20% drawdowns, 2, 20 to 30%, 1, 30 to 40, 1, 40 to 70. And that's all during a bull market. So it takes a certain kind of gumption. It takes an ability to turn off Twitter, to turn off your screens and say, has my thesis changed? Is the adoption of this technology stopping? Is there any other reason that it's going to slow down? Where are we in the business cycle? I spend enormous amounts of time trying to educate you guys that this is a macro asset and it's driven by the business cycle. Just happens to be forward-looking, like technology stocks, and it's driven by the liquidity cycle. So has something changed in the business cycle that would tell us that we're going to have a failed crypto cycle? Well, in all probability, that's a no. So therefore, it's corrective price action. And if you happen to have extra money on the sidelines, use these corrections to add. That's what I did. I was lucky enough to have a bit of cash, and I added to my Solana position. Great. And I found that compounds really well over time. It's a key way to make better returns out of this space is use the drawdowns to your advantage. Even the big cyclical ones. I didn't sell out of anything last time. I had no intention of it. It wasn't that I missed the top or anything else. I knew that to get back in is really hard. If you take X sum out, you never put X sum back in again. You go smaller because you don't want to risk it all. Your whole psychology is screwed up. So what I prefer to do is say, well, this is a longer term trade. When we get the big drawdowns, I just want to add. And then you compound and you're back to all-time highs well before the market is. And that is really, really a superpower. So what's going on now? Why is crypto so shaky? It's the same reason tech's been shaky. It's liquidity stupid. Remember, I've told everything about this everything code cycle. And those of you in Real Vision Pro Macro, and even Pro Crypto, Kevin Kelly and myself talked about it yesterday in Pro Crypto, liquidity is the big driver of all asset classes, and particularly crypto. It's the most receptive to liquidity injections or withdrawals. So I correctly managed to time the bottom in 2022 based around the liquidity cycle. And the forward-looking elements of the liquidity cycle continue well into 2025. So I don't have anything to concern over. So therefore, we're looking at the wiggles in liquidity. And those of you who follow Mike Howell, who's on Real Vision frequently, he also follows liquidity. He's probably the expert on liquidity. And he talks about the liquidity air pocket that I've looked at as well. The liquidity air pocket was happening. If you think about the US liquidity, it's driven by the Fed's balance sheet, which they've been doing QT. So they've been tightening it, making liquidity less available. But that's been offset by the Treasury, by the draining of the reverse repo. The reverse repo is an offset to what the QT was doing. And in the meantime, the other part of the equation is the Treasury General Account, which is the checkbook of the US government that Janet Yellen controls. And she's been building that. But these have meant the liquidity based back in 2022, and it's been going vaguely higher. The everything code cycle taught you that there is no way of financing the debts. It's now become a word people use, fiscal dominance. This is the everything code cycle I started talking 2 years about. The everything code cycle says, well, if GDP growth is too slow, then the amount of debt in the system is too high. So you need either interest rates to come down or you need growth to go up. Now, growth is driven by demographics over time. There's not much we can do about that. You get cyclical growth, but you don't get the overall trend rate growth, which has been slowing. So the available GDP has to pay the interest on the debt between the government sector, that's 100% of GDP in debt, and the private sector is 120% in debt. So we've got not enough GDP to cover the interest payments. This gets really exacerbated when interest payments are high. Trend rate of GDP growth is about 1.75%, call it 2%. Whilst interest payments right now are, let's say, 2-year bonds are 5%. Okay. And then if you double that, taking into account the private sector, you've got 10% of interest payments and nominal GDP growing at whatever it is, 5. So there's not enough GDP, which is why the bond market's been freaking out. Over time, yields have risen, even though the Fed have been talking about cutting rates. And this is the issue of not having enough GDP growth. This is the everything code cycle. So what it leads to is what's known as more cowbell, which is stimulus. Stimulus can come in a number of ways. So the most obvious way is reducing interest rates themselves. That has been a typical path. The other way is the backdoor mechanism of injecting liquidity into the system. Quantitative easing is the best known one. The other one is draining the reverse repo and also draining the Treasury General Account. So those tend to be those, and then there's some more coming, and I'll come into that in a sec. So where are we today? Why did we have the air pocket? Well, QT was going on, so they're selling bonds. The Treasury had started building up cash reserves because tax payments have come into the system. They come out of money market funds and go into Janet Yellen's checking account, and that's taken liquidity out of the system because she hasn't spent it yet, so it's just sitting there. She's been trying to help the market by issuing short-dated bonds. That's drained the reverse repo. But now today, the market's reversed very quickly on another piece of news. The other piece of news was Jay Powell has said, hey, we don't want to sell as many bonds, quantitative tightening, which is we're going to ease liquidity conditions. Janet, on the other hand, hasn't said that she's going to issue more short-term bonds yet. Well, it's a bit impossible because the reverse repo is almost drained anyway. She's going to wait till closer to the election to unleash her checkbook. And throw out money to everybody. And she will do that, and that will come in the second half of the year.
It's hard to argue with some of Raoul Pal's points in this, even if you don't agree with all of his ideas. Video, the world is quickly shifting into a time when technology rules every industry. Investors who get in now will have a big say in shaping that future, and that will definitely include taking advantage of the huge macro opportunity that the cryptocurrency industry offers. What did you think of Raoul Pal's interview? Please share your thoughts in the section below.